Okay, hello everyone. My name is Kevin Kelly. I'm the Director for Community Economic Development here at the Partnership. Welcome to the webinar, which will cover the proposed changes to the Community Reinvestment Act by the Office of the Comptroller of the Currency, and what these proposed changes could mean for the low-income communities that community action agencies serve, and how you can weigh in during the public comment period this month. Our speaker today will be Kevin Hill, from the Community Reinvestment Act manager at the National Community Reinvestment Coalition. Kevin spoke to us earlier this year, back in May, and some of you may have attended that webinar as well. At this point, I'll turn it over to Kevin Hill for today's presentation.
Thanks a lot, Kevin, and thank you to all of you for logging on today. We're going to be talking today about, as Kevin said, protecting and strengthening the Community Reinvestment Act. I'm going to start by giving a very quick refresher on what the CRA is and how it's currently implemented, and then I'll go into what the AMPR is exactly, some of the big issues and proposals that have been suggested, and some of the harmful effects that some of these proposals could have, and then I'll close with what you can do to prevent the Community Investment Act from becoming much weaker and much less significant. The Community Investment Act, as I'll get into, is a very strong tool for bringing more capital into underserved areas and just really creating a conversation with private capital about how they can be serving more people and expanding their customer bases, which in the end result, if done responsibly and fairly, will result in more people having access to wealth and more small businesses being able to expand, and just having many positive effects that'll help us get more towards an economy where everyone has a equal chance to succeed. So I'm going to go ahead and get started. As Kevin said, please do type in your questions as you listen today. I am going to take at least 2 breaks during the presentation to answer questions, and I can only answer them if they've been submitted. So please do submit those. So I'm going to get right into it, starting off with that refresher I mentioned on what the Community Reinvestment Act is. So the Community Reinvestment Act, it was passed in 1977. It's part of a series of attempts to end redlining and housing discrimination and discrimination in lending in general. The first, some laws that were passed before the Community Reinvestment Act include the Fair Housing Act and the Equal Credit Opportunity Act, both of which forbid discrimination to protected classes, such as race, national origin, gender. And then the Home Mortgage Disclosure Act did something different by requiring mortgage lenders to annually release information about this is what happens when people of this racial background applied to me for loans this year. This is what happened. This is how many I denied. This is how many I approved. This is how many I approved with higher interest rates than usual. And the idea behind that was that more transparency would encourage the banks to serve the needs of underserved borrowers, to increase their services to underserved borrowers. And also the idea behind that law was to give advocates a reliable source of data that everyone could use and point back to really make the case if certain banks just weren't lending to certain people. As great and as needed as all of these laws were, there is something that they did not do, which is vitally necessary to addressing redlining and addressing discrimination. These laws forbid discrimination, but they don't require any sort of proactive actions to address it. I think most of us would agree that you can't discriminate against people for generations and then assume if you just take that discrimination away that everyone's going to have the same chances to get ahead. So that's why we need the Community Investment Act. When the Community Investment Act puts a continuing and affirmative obligation, as you can see on the slide, for banks to meet the credit needs of their entire communities, and to do so in a way that's consistent with the safe and sound operation of the institution, meaning that the Community Investment Act does not force the banks to make any loans that's going to just result in foreclosure or result in them not getting paid back. The Community Investment Act wants to see a reasonable extent of the bank meeting the credit needs of everybody and taking steps to meet the credit needs of everybody. And just to provide a little bit more background on sort of how the justification for the Community Investment Act. Back in the Great Depression, when news would get out or rumors would get out that a bank was in trouble, everyone who had money at that bank, if they heard that a bank was in trouble, they would go quickly and they would take all their money out of the bank. Because back then, if a bank failed and you had money in that bank, your money went away with the bank. So if the bottom fell out of that bank, your money was gone with it. And that actually kind of accelerated economic hardship, because sometimes rumors would get out that weren't founded that a bank was going through trouble, but because people heard about that, they would start pulling all their money out, and it became kind of like a self-fulfilling prophecy where now that bank was having economic problems. And so as a response to that, when the New Deal, the government created the Federal Deposit Insurance Corporation, which basically makes it so everyone can bank safely, knowing that if the bank fails, up to $250,000 of their money is safe. Up to $250,000, no matter what, it's insured by the federal government. So when the Congress passed CRA in 1977, they established kind of like a quid pro quo, saying that if the government's going to provide that sort of insurance, of us as taxpayers are going to provide that insurance, then the bank then has to be taking steps to make sure that everyone, to a reasonable extent, is being served, and the community needs of the credit and capital needs of the entire community are being met. And so that's how the Community Investment Act works. It does not currently apply to credit unions or to any institutions that do not take federally insured deposit dollars, because there's that sort of quid pro quo. And the greatest thing about the Community Investment Act is it creates this framework for the community to engage with the bank. And that's now I want to talk about now. What the Community Investment Act does is it sets up this system where anyone can comment and address the regulators to look at specific issues that they would like the bank to work on. Those can be issues in the specific bank's lending, or they can also just be specific issues that are coming up in the community that people in that community really think the banks need to address if they want to be seen as sort of meeting the credit and capital needs of that area. I do these kind of trainings around the country, usually in person, but sometimes over webinar. And how I usually start the training is I ask people, for a show of hands, can you tell me in the past 2 years if you've either voted or you've gone to some sort of demonstration or anything like that? And usually the vast majority of the audience usually raises their hand. And then I usually follow that question up with, in the last 2 or 3 years, have you commented on a CRA exam or a merger? And usually almost all the hands usually drop after that. And that's really unfortunate, because just imagine, I mean, we have the midterms tomorrow, and I really hope all of you vote, but just imagine an election where 90% of the population, or even more, 95% of the population is not participating or is even aware that it's going on. That's kind of the current dynamic we have with CRA, unfortunately, where there's lots of groups that are aware of it, but there's many that are involved in this kind of work that the CAP agencies are involved in that are not aware of CRA exams and this sort of process for commenting. So that's why I want to take some time on it, talking about it now before we go into the sort of changes that have been suggested, because then you'll know more about how serious some of the proposed changes are. So banks, the framework works like this. Every bank gets a CRA exam every 3 to 4 years, and currently those exams test the banks on these 3 tests you can see here. There's the lending test, which looks at how well they're lending to low income borrowers in neighborhoods. That actually accounts for half of the current score, which makes sense because the Community Investment Act was passed as a response to redlining. So we would want the biggest thing to be sort of their lending to low to moderate income. So there's that test, which is the most important test, accounts for half the score. And then there's also an investment test, which looks at the level of support that they're giving to needed community development projects. And then the final test is the service test, which basically looks at are they maintaining branches in low to moderate income neighborhoods, and are they offering what's called CRA services, which I'll get into in a bit. And the greatest thing is you can comment or vote on how well a bank is doing on each of these aspects of their performance, and your comments have to be taken into consideration and also available for the public if someone else from the public should request to see them, see comments that have been submitted in what's called the CRA public file. The bank gets each of these three tests. They're examined on the lending, investment, and services in what they call the bank's assessment area. And the bank's assessment area is basically wherever the bank has branches, wherever they're taking federally insured deposit dollars. And this is important to know so that whenever, as you go home, as you go to work, if you see a bank branch in your community, know that that means that that bank is being graded every 3 to 4 years on how well it's serving your community, and that you can and should comment on that and use data and personal experiences and things like that to make an effective comment. And this is a big deal because studies have found that banks lending in their assessment areas, or again, the markets where they have physical branches, is less likely to result in foreclosure than lending done outside of assessment areas. Let me unpack that a bit. So if you look at the loans that a bank makes in the markets they have branches, meaning in the markets where they're CRA regulated, those loans have been shown to be safer and sounder, meaning less likely to result in foreclosure than the loans the same exact bank is making in other markets where they don't have physical branches and where they're not currently being CRA evaluated. So that the activities and the loans that they're making in the markets where they don't have branches, it's kind of like a blind spot under CRA currently, and that has a serious impact because those loans are shown to be more risky. So that actually is a strong argument for why CRA should be applied to more of the lending marketplace. And beyond CRA exams, there are also the cases of mergers and acquisitions. When a bank wants to grow, it typically does not grow through things like ad campaigns or things like that. The biggest way for banks to grow is to buy another bank or to buy branches of another bank. And branches come with, again, federally publicly insured deposit dollars, which are insured by all our tax dollars. And so when that happens, banks have to apply. They can't just go buy another bank or branches of another bank like we can go buy something at the store. There is an application process which involves a comment period. And during that process, which you can comment/vote on, the regulators are doing a couple things, but as relates to CRA, they're looking at the previous record of the bank. I mean, they're looking at their CRA exams, looking at so what does the CRA exam indicate that this is a bank that's struggling to live up to its CRA obligations, or is this a bank that's really doing a great job on its CRA obligations? And then they also look at going forward, if we allow this bank to expand, how will the public benefit? The CRA and the bank merger regulations establish that the benefits of banks growing cannot just go to the shareholders. There also has to be a public benefit associated with it. And we and CRC use this as an opportunity to negotiate public benefits plans. And again, I really encourage you to get more knowledgeable about this process, because to use the voting metaphor again, think of these mergers and acquisitions as sort of like special elections that come up. And these come up at least about 20 or so of these a quarter. Our bank mergers get announced around the country, and in the vast majority of these, no one comments because they're unaware of their ability to. And so think about that. The vast majority of elections, basically candidates running unopposed. And think about how responsive to community needs you think an organization, a candidate or a bank would be if they know when they go through these processes, virtually no one's going to comment. And on the flip side of that, think how much more attention could be given if all of a sudden they did start to see comments when they weren't expecting to see any. So the CRA does using these processes, we at NCRC have had a lot of successes. My job, CRA manager, as Kevin Kelly said in my introduction, I work with our members and I manage our campaigns where we use the CRA to get banks that we've identified might have some issues to enter into community benefits agreements with the banks that clearly spell out how the public will benefit from their being permitted to grow larger, and also spell out this is the sort of increases in lending and the steps we're going to take to be stronger members of the community. Since 2016, we've been able to use this process, the CRA exam process, the merger process, to negotiate 7 agreements that, if you add them together, are going to put $86 billion into underserved communities. Not $86 billion to NCRC, but $86 billion into underserved communities. And by underserved, I mean communities of color and low to moderate income communities, as well as 41 additional branches into these underserved neighborhoods. It's not just numbers. We've also been able to get some pretty unique commitments from banks, such as we got a bank to agree to stop funding payday lenders. And this was a bank that was a pretty significant funder of the payday lending industry, and we got them to commit to pull out of that industry. We've also gotten some pretty innovative philanthropic programs from banks, such as a program for minority women and immigrant-owned businesses that was grant dollars for for-profit businesses. I used to work in the business development space, and I can tell you that is insanely rare. As an example of something we were able to accomplish using CRA. More specifics on how CRA relates to nonprofit organizations. CRA requires banks to support community development that meets pressing community needs. Remember that investment test that I talked about. Part of those investments includes philanthropy and grants. There also is a component of the lending test that looks at community development loans, which are loans that support community development. And so how the CRA defines community development is affordable housing, small business development, economic revitalization, which is things that create more higher paying jobs in economically depressed areas, or social services to low to moderate income. Now, I'm willing to bet that most, if not all, the people on this webinar, the work you're doing would fall into those definitions. And so there right there is a pretty direct connection to how your work in CRA is related. Banks would get CRA credit for supporting you in that work, and also banks are required to support that kind of work. In addition to that, nonprofits also can play a very valuable role in assisting banks and regulators with identifying what are the most pressing community needs in an area. And also nonprofits also do a pretty important role in identifying and preparing borrowers for banks that can help them increase their lending. Think of any organization, if you've ever done a first-time home buyer workshop, or if you've ever provided technical assistance to small business owners. Those are all things that are CRA eligible and that help banks increase their market share and improve their CRA performance. If you want more information on how to get involved in the CRA process, this is what NCRC does day in, day out. We can guide you through this process. We have 25 years of experience. We also provide action alerts, which are monthly alerts that detail banks that are coming up for mergers, banks that are coming up for CRA exam. We can help you run data to see if a bank is not quite living up to its obligations. We can also assist you with comment letters and help you construct agreements. There's a link right there on your screen if you're interested in our membership application. I was planning on breaking here to take some questions because we're now going to get into the sort of heart of the matter of the ANPR, but I don't see any questions submitted yet. So I'm going to keep going, but this is a reminder to please do put in some questions because I'm happy to take them. But I'm going to move forward for the time being. So let's get into why we're here, why we're on this webinar today. We're here the crux of what we're talking about today is the proposed rule changes to the Community Reinvestment Act in this sort of CRA review process. So the OCC's released a document, which there's a link to it there on your screen, and this is the beginning of a process for changing the CRA. That document asks a series of questions about how to change how the CRA is implemented, and they also offer a few examples of their own. And this document was put out again by the OCC, the Office of the Comptroller of the Currency, which is the regulator of our nation's largest banks. And anyone can comment. There's a link there to the site where you can submit your comments, and the comments are due by November 19th. And the comments will be taken into consideration by the OCC and inform the next step of this process. And the next step of this process is when the OCC is going to come back out with a document that instead of being a series of questions like the ANPR currently is, the next document will be an NPR, or Notice of Proposed Rulemaking, and it's going to have very specific information about this is how we're going to change CRA. And the idea here is that comments submitted now will inform the direction the OCC goes in. So that's why this is really important, because this is an opportunity to really tell the OCC and show the OCC how important the Community Reinvestment Act is to your organizations and to your communities, and to advance sort of a different agenda for making sure the CRA is stronger at getting more resources to underserved communities and a little bit stronger at holding banks accountable. A lot of as I'll get into in a second, a lot of the proposals that have been suggested by the OCC are more on the other side of making things easier for banks and making it easier for banks to pass their exams. Before I start getting into the specific proposals, just a couple of things to keep in mind. Currently, 98% of banks pass their CRA exams. 98%. So the worries that the OCC talks about of banks feeling confused or feeling like they're unaware of what they need to do for CRA to pass, I really, it's hard to take that with anything more than a grain of salt, because 98% of banks are passing. Also, as you can look up, this year has been one of the most, if not the most profitable years that the banking industry has ever had. So this idea that the banks are in deep need of relief now, and they're being very confused by CRA, I would really argue that there's not a lot of truth to that, and that it's actually much more important that we make the CRA stronger, so it can be an even more effective tool for our communities than it already is. So let's now, and again, folks, please do submit questions as you have them. But let's get now into the specific, some of the specific proposals. The first one that I want to talk about, and this is kind of seen as the biggest idea the OCC has had for this process, is this idea called one ratio. Remember when I gave the quick refresher on the Community Reinvestment Act, that the Community Reinvestment Act currently works by putting the banks through three separate tests: the lending test, the investment test, and the service test. And the lending test is weighted the most heavily. The one ratio would change that. The one ratio would move into sort of this fraction, which I've attempted to illustrate on your screens, where the bank's lending to low to moderate income borrowers and neighborhoods would be combined with the bank's combined with community development loans and investments, combined with philanthropy, combined with any other activities that the industry is able to get CRA credit for as a result of this process, and you'd add that all together, and then you would divide it by, say, the bank's assets or their Tier 1 capital or some measure of the bank's capacity. Now, if this happens, I think it's just kind of human nature. What's going to happen is the banks are going to figure out the quickest way to get them to the ratio or score they need to get is going to be things like large tax credit deals and things like that, the biggest dollar value they can find. And those deals are largely going to be in our largest cities. And it really will create, sort of unintended or not, a sort of disincentive for banks to work on things such as smaller dollar grants or anything that's more time and labor intensive, like working on first-time home buyer workshops that will generate more loans to low to moderate income people, because loans, particularly smaller loans that that a low to moderate income homeowner or small business might need are only going to go so far for the 1 ratio. And also, I mean, having the previous approach of the 3 tests, that at least ensures a certain minimum, a minimum of lending, a minimum of investment, and a minimum of services, since they're graded on all 3 separately. Grading on all 3 at once, though, doesn't ensure that. It basically makes it so banks can now choose how they fulfill their CRA performance. And things like lending, which can take a little more time for the bank, really could get the short shrift and not get as much attention from the bank anymore if the bank knows they don't have to pay as much attention to it anymore. Also, the process of groups being able to comment and direct the regulators to specific local issues, that really could go away if we move to this sort of very strict quantitative approach for measuring CRA. In fact, you can go online and you can look at some of the comments that have already been submitted on the ANPR, and there was a kind of disturbing comment submitted by a financial institution in New Mexico, where you see their comment, and it looks like a form was prepared for the bank to help them comment, and there's a multiple choice questions. And one of the questions asks, if we move to sort of this 1 ratio style approach, will there still be a need to work with community groups on CRA exams and the CRA process? And there's a series of answers, and one of the answers is no, that will not be necessary anymore. And the bank chose no. So I think we can see that there is a strong difference of opinion on the banking industry on sort of the intent of CRA and sort of the function of how CRA is implemented. And this idea of just making it so it can be done the quickest way possible, not everything it has a very quick, easy solution. And I think addressing the long-term effects of redlining and addressing ensuring that everyone in our communities has an equal chance, and the banks are at least doing a reasonable extent of making sure that they can meet the credit needs of everybody. That's not necessarily something that lends itself to quick, easy solutions. And I think moving to this 1 ratio idea will really send widespread negative signals to the banks that they don't need to work as hard anymore on CRA, and that they can sort of just kind of buy their way into where they need to be in this 1 ratio, and to not really listen to local needs or pay attention to local needs as much. And to be clear, before I move on, in CRC, we do not oppose the use of metrics at all. We use metrics all the time. We just don't believe that a single metric should be used to evaluate something as important as a bank's CRA performance. Other questions and proposals that have been suggested that are kind of worrying to us is the ANPR openly asks if branches in low to moderate income areas should be reviewed on a CRA evaluation. Meaning, like, is that not something the CRA should even look at anymore? And we think that the answer to that question is a pretty easy yes. Yes, we need to keep branches on CRA, and yes, we need to continue to evaluate banks on how well they maintain branches in low to moderate income areas. De-emphasizing bank branches on CRA exams will inevitably mean less bank branches in low to moderate income areas, which means less services in low to moderate income areas. And there's been studies that show the harm that branch loss has on home and small business lending. Even studies that the FDIC has put out as recent as 2015 still find that many households, and particularly underserved households, disadvantaged households, still do use a lot of bank branches for their services and things like that. So we definitely do not want to see a move away from evaluating banks on how well they maintain branches in low to moderate income areas. The credit outside of assessment area issue. I touched on this a bit earlier when I was giving my refresher. Remember, currently the CRA only evaluates banks on their activities in the markets where they have branches, what is called their assessment area. and there's this big blind spot of their activities in their areas, or the activities they're doing in the markets where they don't have physical branches. This has been a major CRA issue basically since the CRA was enacted, and really since technology allowed banks to be able to lend in areas where they don't just have physical branches. And the ANPR attempts to address this issue, but their way of addressing it is not helpful. The ANPR suggests just summing up all of the activities the banks do in the markets where they don't have branches and just summing it all up in aggregate. It's kind of you can kind of see the MO of the OCC a bit here. They're very big on simplicity. They're very big on combining lots of things. But again, here we feel like that's going to do more harm than good. We would much rather see, say there's a market where a bank doesn't have branches, but they still make a significant number of loans. We would much rather see a creation of additional assessment areas. So that way the bank would be evaluated on how well they're meeting the credit needs of that market, that they're a substantial player in, and just like they're evaluated on their markets where they have branches. We think if going in the OCC's approach here, where you just sum everything up, you're going to create a situation where the bank can only receive positive consideration and can't receive any negative consideration. So let's say in a market that a bank is lending in, let's say they make 100 loans a year in, so significant market for them, but only 3 of their loans of that 100 went to low-to-moderate income people. In the OCC's approach, the bank would just get credit for those 3 loans and move on. But in our approach, the bank would get evaluated on how come only 3% or 3 of your 100 loans went to low-to-moderate income. What steps are you taking to increase that? We think that actually would go much further in meeting the needs of these areas where they don't have bank branches than the OCC approach of just rounding and grabbing everything up and putting it in there. Because then under that approach, the bank really has very little incentive to actually meet the credit and capital needs of low to moderate income people in these markets so they don't have branches. The issue is a bit complicated, I'm not going to lie. But we really don't think that the OCC's proposal is a good one on this issue. There also is lots of language about expanding what counts and kind of playing around with definitions, which again, I would argue just at the end result of all this is just making it easier for the banks to pass their exams. But remember, 98% of banks currently pass. So we don't really, if anything, we should be going in the opposite direction, because I guarantee you, everyone can tell you that 98% of banks in the country are not currently doing at least a satisfactory job of lending to low-to-moderate income borrowers, lending in low-to-moderate income neighborhoods, supporting needed community development projects, and maintaining branches in low-to-moderate income neighborhoods. And also, it does a disservice to the many banks that are doing a good job. There's tons of banks in there that are doing a good job, and they're weighted down by all these other banks that are barely doing a good job that get the same grades they do, because CRA is currently so enforced so laxly. So it would be better for the banking industry and the positive banks that are out there if we actually had more stringent CRA enforcement instead of less CRA enforcement and easier exams to pass, which is what the OCC recommendations largely do. Talking about one specifically for changing definitions and sort of expanding what counts. Currently, banks get credit for lending to small businesses. CRA defines a small business as a business that makes less than $1 million a year. Now, many people have told us over the years that that definition is not the best, and that by the time a business is getting close to that $1 million a year range, they've kind of got it figured out for the most part, and it's not as hard for them to get bank capital as much anymore. And that's something we're sympathetic to. We do think that maybe there is some merit to looking at that definition and possibly lowering the asset threshold. However, the OCC wants to go in the other direction. The OCC has suggested using the small business standards and defining as a small business loan any loan made to a business that would meet the small business SBA's, Small Business Administration, small business standards for a small business. Now, these small business standards that the SBA makes vary widely by industry, and the SBA puts these out, I believe, on an annual basis, and it's this long document that has every industry you can possibly think of, and for that industry, it'll have specific. This is how many employees. For a business in that industry, this is where basically the line is from you being a small business and you being a large business. And sometimes that line is based on number of employees. Sometimes that line is based on the amount of revenue. And largely the SBA does this for fairness in government contracting, because in those industries there may be there are certain industries like manufacturing, mining, things like that, where setting the threshold entirely at just $1 million would be kind of unrealistic, and it would hurt businesses that are competing with national and multinational corporations for government contracts. We completely agree with that. However, it's inappropriate to do the same thing and apply it to the CRA, because remember, the CRA is about addressing basically what are market failures from the banks, to where just through their everyday operations, they just were consistently ignoring and neglecting the needs of, in this case, small businesses. And a lot of times the needs of low to moderate income people, but specifically in this case, small businesses. Now, and that's why we have CRA to really encourage banks to address that market failure and to meet more of the needs of more people. And more underserved businesses and more underserved people. So why then, to use an example of what would be considered a small business by the SBA standards, a used car dealership that makes $25 million a year would be considered a small business. Now, if you're a business making $25 million a year, banks are going to give you loans. If you want a loan, they're going to give you one. You're not going to have to go out of your way to get a loan when you're a business making $25 million a year. So that kind of illustrates how absurd it would be to change the CRA definition to open up basically open up the box to almost any commercial loan the bank's making. They could probably find a way to consider it a small business loan, unless it was a loan to like Boeing or Amazon. So we think that'd be a very inappropriate change to CRA. Other ideas about expanding what counts. As I mentioned earlier, the banks get credit for what's called the CRA service hour. Some of you may have banks that sit on your boards, and hopefully when you're at board meetings, the banks that are there participating and offering their technical expertise and things like that to really assist your organization. And I say that because most likely the bank is reporting that time they spent at your board meetings as a CRA service hour, meaning they're reporting to their regulator, say the meeting was 2 hours. I did 2 hours of CRA service because I sat at this board meeting, so give me credit for my 2 hours. And currently how this works is if you did 2 hours, you get credit for 2. It's like a one-to-one kind of system. And the OCC has suggested changing this and monetizing it. So instead of it being sort of the 2 hours gets you 2, it would be they would multiply the 2 hours by what they call an average labor rate. So let's say a bank does 100 hours of CRA service, and the average labor rate of their bank staff was determined to be $40 an hour. Do the math there. All of a sudden, the bank has turned something that used to be considered 100 into 4,000, and they've done this while offering no additional services. And if you keep in mind the sort of one ratio approach that the OCC is advocating for, this is just another way of just making it even easier for the banks to pass their exams. So that's not something that we would support. Also, on the topic of expanding what counts, this is not actually in the ANPR currently, but based on previous statements made by the banking industry groups such as the American Bankers Association and the Independent Community Bankers Association of America, we expect the banks to push very hard for reducing the need for CRA-related community development to be focused on helping low to moderate income people in communities. We say this because we've seen them make these statements in the past. We've seen them make the argument that, hey, we're all in a community together, so things like infrastructure and hospitals and wealthy neighborhoods should be considered CRA community development because we're all one big community. Again, I have to remind everybody about what the purpose of the CRA was. The purpose of the CRA was banks were not serving the needs of low to moderate income areas, low to moderate income people. Unfortunately, a lot of those needs still go unmet today. So it would be very inappropriate to change the CRA to expand the focus away from low to moderate income, because we know that just inherently is going to mean less for low to moderate income. And we still have work to do on ensuring that their credit and capital needs are met. So that would be very inappropriate. And so those are sort of the big negative proposals that have been suggested. But we also want to use this as an opportunity to advance our agenda for making the CRA stronger and a more effective tool for our communities. And so there's a number of areas that are missing from the OCC's suggestions that we want to advance. The first one being that it is time for CRA exams to include an analysis of a bank's lending to different racial groups, as the law was originally intended. CRA was a civil rights law, and it's a civil rights law that was made colorblind. We disagree with that, and we think it's time, and we're going to use this process to say in our comments that it's time to go back to the law's roots and to look at a bank's lending based on race in addition to income. We also think that it's time for the regulators to start recognizing community benefits agreements. These are agreements that financial institutions enter into with community groups that detail how the banks can improve CRA performance, and also typically go through their strategies and how nonprofits can partner with the bank in achieving those goals. These are win-win situations. They help the bank increase their market share and get more customers, while also helping community groups see what the priorities of that bank are over the next couple of years and what the partnership opportunities are. And then also then resulting in more loans, helping more people get access to wealth and things like that. So these are win-wins that we want to see recognized by the regulators, and they currently are not. And then finally, the affiliate issue. People sometimes think I'm making this up when I say it to them because it's so crazy, but it is real, unfortunately. Let's say many banks decide to structure their lending operations in a different business, what they call an affiliate. They own the affiliate, so it all kind of funnels up to the same place, but they consider that technically a separate line of business. And currently, under current practice, the banks can dictate to the regulator if that affiliate's activities are included on a CRA exam or if they're not. So let's say, let's use a real example. There's a bank called SunTrust. SunTrust has an affiliate that does most of their mortgage lending. And there actually is a big question, and SunTrust's mortgage lending affiliate got in trouble a couple years ago with the Department of Justice for how they were running the HAMP program, which was a program for helping people modify their loans if they got into a bad loan through the housing crisis. And it was found out that SunTrust's mortgage affiliate that was in the HAMP program was criminally neglecting their treatment of people's applications to be a part of that program. Really going out of their way to make sure that they did not meet the needs of these customers, even though they were receiving government benefits for being a part of this program and supposedly working with people on modifying their mortgages. Well, SunTrust chooses not to have their affiliate be included on their CRA exams, so SunTrust could basically avoid having downgrades because they can tell the regulator, I want you to grade this line of my business but not the other line of my business. To simplify it, it'd be like when we were in school, if we could go to our teacher and tell them, you know, I didn't really pay a lot of attention when you were talking about chapters 3 and 4, so don't test me on that. But chapters 5 and 6, go away, go test away. I really paid attention that week. So that makes no sense, and that's something we want to see end with this process. So I'm drawing a conclusion, folks, and again, please do submit some questions. It looks like I'm going to have about 10 minutes for questions at the end of this. The stakes are extremely high here, folks. We've done some forecasting and some estimates, and we estimate that if these proposals that I've just went through are carried out, and if the CRA is weakened to that extent, we anticipate seeing a loss across the country of $105 billion. That'll be $105 billion less in mortgage lending and small business lending in low to moderate income neighborhoods across the country over the next 5 years if these proposals are carried out. And actually, there's a link on your screen right now where you can download a report that shows how much your state will lose if the CRA is weakened by enacting these proposals, as well as how much your specific congressional district could lose if these proposals are enacted. So I encourage you to look at that. And then just to close off, what can you do? We need your votes or your comments. We need you to submit a comment to the OCC that clearly details rejecting the unhelpful proposals that have been suggested that I've gone through, head off any unhelpful proposals that we are likely to see from the banking industry, and really advance an agenda for strengthening the CRA. We really need the Community Reinvestment Act in order to really address social inequality and address the continued legacy of redlining and discrimination. It's hard enough doing this kind of work and community development work and then advocacy work related to community development work with the current CRA. It's already very hard, and it's just going to get much harder if we don't have this very important tool in the CRA, or if the CRA becomes a shadow of its former self through this process. So to help you comment, we developed a page. There's a link to it on your screen there that has additional detail on the ANPR, has resources to help you comment, such as a sample comment letter, and also instructions for how to comment, and as well as for encouraging others to do so. At most, this will probably take 20 minutes of your time, folks, to submit a comment letter, and it really is important. We cannot lose the Community Reinvestment Act. So I really encourage you to get online, fill out your comment, and if you need help, if you have any questions, my email address is khill@ncrc.org. Send me an email, and I look forward to talking to you and working through any questions or issues you have. Because this is really important, folks. Tomorrow is an important day, the midterm elections, but November 19th is also very important because we cannot afford to lose the Community Reinvestment Act. So with that, I was going to turn over to questions, but still haven't quite seen any. So Kevin, I don't know if you have some last words or anything you want to say to wrap us up.
Yeah, actually, I have a couple of questions maybe while I'm asking people to submit some other stuff. You talked about the deadline on the 19th, and then they're going to submit another document after that saying this is what we're going to do. What's sort of the last deadline for when this stuff will be implemented, whatever it ends up being?
Well, thanks, Kevin. To be clear, the comment deadline to influence that document is the 19th, so we definitely need to get comments in by the 19th. But yeah, after the 19th and after the comment period closes, the next step is the NPR, the Notice of Proposed Rulemaking, which will be the specific. It'll be informed by the comments that are submitted, and it's sort of the very specific. Okay, this is how we're going to implement the one ratio. Hopefully not, or this is how we're going to change the definition of small business lending, or this is how we're going to start including race into a CRA exam. Mm-hmm. That's when you really will start seeing the very specifics of how the CRA is going to change. But at that point, a lot of that's going to be kind of predetermined. So that's why it's so important for people to comment now.
And the OCC is one of several bank regulators. Are other bank regulators also going to be weighing in on this?
Yeah, that's another good question, Kevin. So the three main CRA regulators are the OCC, the FDIC, the Federal Deposit Insurance Corporation, and then the Federal Reserve. And the OCC regulates the nation's largest banks, or they're nationally chartered banks, which tends to be the nation's largest. The FDIC regulates state chartered banks, and then the Fed regulates some that elect to be regulated by the Federal Reserve instead. And so yeah, the other regulators, so far the OCC has released this unilaterally. So there is some question about if the OCC changes CRA, does that just apply to the nationally chartered banks? Does that not apply to the FDIC regulated banks or the Federal Reserve regulated banks? That question is still very much in flux. All we know right now is this is how the OCC is moving forward, and the OCC has, since the change in administration, the OCC has been come out on record of being the more industry friendly of the three. They've done things like already they've reduced penalties for if banks are found engaging in discriminatory conduct. Previously, before the current administration, if a bank was found engaging in discriminatory conduct, they were basically given an automatic CRA downgrade. The OCC has already changed that and provided ways where they wouldn't necessarily get an automatic downgrade anymore if they were found guilty of, or if they settled over allegations of discriminatory conduct. So there's a lot of stuff going on with the OCC, and that really just kind of elevates the importance of people commenting to the OCC and pushing back on some of their ideas. And the last point I'll make on that is last week, Martin Gruenberg, who used to be the head of the FDIC and is still currently on the board of the FDIC, he even publicly made a statement basically saying that, yeah, the one ratio idea will dramatically change the Community Reinvestment Act for the worse. And Martin Gruenberg, he, like I said, former head of the FDIC, so that's not an NCRC staffer like me. And he's coming out and saying, like, yeah, this is not a good way to go. So again, folks, the moral of this message is we really need the OCC to hear loud and clear not to do these things, and this is not the direction you want to go in.
I have a question here. Is the partnership submitting comments on behalf of community action agencies? And the board of the partnership is actually having a retreat at the end of this week, so that's one of the questions that they'll be dealing with at the retreat. The CAFI board, which is a subsidiary, discussed this, and then through emails, the majority of them have said that CAFI will be submitting comments. So that's where we are on that. And let me see, I think there's another one possibly here too. Nope, that's all I see here.
All right. Well, yeah, thanks again, folks. My email address, again, if you want to reach out to me, is khill, Hill, at ncrc.org. And again, please do comment.
Okay. Thank you, Kevin. Thanks, everybody who's on the call. As I said, we will be sending out the link that has the PowerPoint presentation as well as the audio recording, and we'll also be putting it up on the website. So thanks again, and please join us for a future webinar later on. Thank you.